That interaction, my friends, is the marketplace. And if you really understand that, and you understand how things are going to work in terms of the auction that is the market, and you understand the mechanics of that market, this is how we can make short-term trading work. You don't have to just look at the fundamental information as long as you understand the mechanics of the market. And believe me, the missing link in probably 99% of the stock or options or futures or Forex trading courses that you've ever looked at is that simple example. Okay? That simple example is the marketplace. Now, let me take another drink because I got myself riled up again. Okay, sorry about that. I apologize. Now that we have a basic understanding of the market, and if you really want to get a feel for this, I would strongly recommend that you go to the exchange. In fact, you know what? I might see if enough people are interested, I can probably arrange to have us go to an exchange or maybe even one of the big bank trading floors. And you will see how all of this actually plays out. I mean, what I described to you is exactly what is going on at this exact second in Asia. Of course, it's probably being done in Japanese and Cantonese and things like that, but you get the general idea. The market makers are constantly watching order flow. Order flow drives the market. It's not even, and see, this is where the academic theories go completely off the tracks. Okay, and I would argue this till I'm blue in the face. I don't care if you got a PhD from Harvard or a PhD from MIT. The guys that are on the ground, when Wyckoff looked at the people who were actually making the trades work, they did it in this manner. Okay, they were looking at order flow. So the academic community would say, well, you're not going to see the market move until there's a trade. Well, that's not true in the least. You'll see a tick. You'll see a blip on your chart when there's a trade. But let me tell you something. If you're looking at, say, Deutsche Bank, okay, a huge bank, you know what, I'll use B of A so I can write it quickly. If you're a Bank of America and you're a big money center bank and you all of a sudden see that 9 or 10 of your biggest clients are all selling, what do you think is going to happen in the market? I mean, think about it. If you've got billions and billions of dollars that are being sold, do you think that the dollar's going to go up? Well, short term, probably not. So if those orders have come into the market, what are you going to try and do? You're going to try and make the best out of that particular situation. So that's my segue into the Little Dipper. Now let's look at this in terms of orders to buy. Okay? Now in this example, remember we used the example of a house, but so we have all these orders coming in. And the market maker sees that there are a bunch of orders that are all lined up, and they push price up. And price has already moved up off of a support level. Now remember in the introduction I said that in fact, let me write it on top. We're looking at now this computer, Little Dipper. Okay? Let's take a breath. Now we're talking about actual trading tactics. Okay? All the rest of that was mechanics. Now let's make it work. Okay? We learned how to take apart the engine. Now let's learn how to drive it. Once you've entered a position, let's say for whatever reason you were long down in here. Somewhere in here you go long. Okay? And you're anticipating that the market will move up. The market's at support, it's at a logical point, whatever your reasoning is, flags, pennants, etc. So you see the market move, and you've got a position now that's got some profit in it. Well, one of the functions of a big trading outfit, now not a market maker,